So one of the most common silvicultural prescriptions and financial investments in the world of forestry is the plantation, which is a stand of planted trees designed to optimize timber production. And while plantations usually do represent the highest production on a volume basis, how do they perform financially? That's what we're going to look into today. And we're going to be using the financial analysis tool from SilviCultural.com. So SilviCultural, if you weren't aware, is my new online platform for forest management. It combines social media functionalities with some various software and tools that you can use to manage land on a small scale basis. Now, the community is free to join, and we're already starting to see some nice engagement on that, so thanks to everyone who has joined so far. And it comes with a premium option if you choose to upgrade, in which you have mapping, a growth estimation tool, and the tool we're going to be using today, which is financial analysis. Now, very specifically, what this tool does is estimate the net present value and internal rate of return for a given forest investment. And that's a very particular metric. What it is essentially doing is valuing the investment on an opportunity cost basis. So it is comparing this set of cash flows to an alternative set of cash flows that could potentially provide a better rate of return. So it's looking at anticipated cash flows, both expenses and revenues, and then discounting them to the present versus an alternative rate of return you could be getting. And of course, we're going to talk more about that as we go. So what I'm going to be using for an example today is a Norway spruce plantation planted in 1969. And this is actually from Irving Woodlands Ground in New Brunswick. I visited it back in 2019, I believe, and it was planted in 1969. And the reason we're going to be using this basically is because it has this nice sign here that has all the data from their harvests and the growth rates and so forth. So it's a really great example. However, and this is a warning, this really does represent the best case scenario for volume production in the northeastern United States. Norway spruce is not native to this continent. It's from Europe, as you might have guessed from the name, and it really does pump. So even though it is similar to the spruce species we have here, it is very different in terms of the actual growth rates and volume production. So I don't think you're going to plant white spruce and get these numbers, or even Norway spruce. Every situation is going to be different, and the numbers are going to vary pretty drastically. The purpose of this exercise is really to show you first the mechanisms of a planting investment, because it's going to be pretty similar whether you're in the northeast or southeast. There's going to be some differences, but the overall idea is the same. And I think this is going to be a good way of showing the advantages and disadvantages of planting and whether or not it makes sense, especially if you're a smaller landowner. It's also a great way to learn the idea of time value of money and how it relates to forest investment. So let's get started. So first we have the stand name, and this really doesn't have any bearing on the analysis. It's just for your own organizational purposes. So I'm going to call it Norway spruce. And for acres, this is the acres of the stand to be planted. I will put in 50. That seems like a good number. So next up is the real consequential number. This is the discount rate. This is the hypothetical rate of return you can get from an alternative investment. And this is what we're going to be discounting future cash flows against. Now, in the past, I've talked about this concept, and I've warned that you have to be choosing an alternative investment with similar risk. And that's difficult with a forest because forests represent a very unique set of risks compared to other investments. Rental properties, they can decay if they're not taken care of. Farmland, if it's not planted and taken care of, it grows back into a forest. Forests, you can ignore them for a century and they'll just keep growing wood. So it is really a unique set of risks, and in the past I've talked about choosing a discount rate that's only 1% above the rate of inflation. However, planting is a bit different. Planting is inherently riskier because you put a lot of the capital up front and you can just lose it. You can have an insect outbreak that can eat all your seedlings. You can have a drought that causes a mass mortality event, something like that. And once those trees die, there's no way to recoup the cost of the actual investment. The land is still there, but the investment in planting is just gone. So I think using a normal set of risks is probably appropriate. So I think this time I'm going to go for a discount rate of 5, and I'm going to choose, I'll just skip down to inflation for now. I'm going to choose an inflation rate of 2%, the Fed target, whether or not that's realistic. Okay, so the next thing we have the rotation age, and this is the age from the beginning of the growth cycle, so age 0, to the age of final harvest. And I think it would be good to choose a nice round 50 years. I visited the stand in 2019, and it was planted in 1969, so that actually works out quite well. Next, we have the tax rate per acre, and this is definitely going to be one of those numbers that's going to vary pretty drastically. This can be as low as $2 per acre if you're in a state subsidized tax program. Could be as high as $100 per acre if it's a property that's attached to your residence. But I think a pretty good number to use for this analysis is going to be $10 per acre. Now we also have these sections here for lease and rent revenues per acre and other yearly revenues. We're going to leave those blank. We're going to assume there's no other revenue coming off of this 50-acre stand. So next we have one that's a little bit tricky, per acre land cost. And a lot of you might be thinking, well, my land I bought in 1983, so how do I figure that? And you might put in the 1983 price or something of that nature. And that's what's important to understand about this analysis. We're not looking at cost basis. We're not retroactively looking at the rate of return you received. We are comparing a future investment against an opportunity cost. It's all about opportunity cost. And opportunity cost is constantly incurred. So if you are holding a property today instead of selling it, that is the same thing conceptually as buying the property today. So if you imagine you're holding a stock and you see that the stock goes up in price, you have the option of selling it. If you choose to keep it, that is, again, conceptually the same as choosing to buy it at that price. That's how opportunity cost works. So whatever the per acre land cost is today, that's what you should put in. And again, doesn't matter what number I choose, it's going to be pretty different across the country. But I'm going to put in $1,000 per acre, which is a pretty realistic price for a at scale, we'll call it at scale property in the northern Maine. All right, now that that's done, we get to do the fun part, the lump sum revenues and expenses. Now, these are essentially the returns you're going to get in the form of harvest and also the investments in the form of upfront expenses. And because in a plantation, a lot of the expenses are front loaded, we're going to start with those. So of course, a plantation is most of the time, 99% of the time, going to start with a clear cut. And you might think that you'd be able to just go in and plant trees after you clear them. But that's not the case. A clear cut is going to introduce a lot of biological and physical barriers to the actual act of planting. We got to take care of those. And we do that with something called site prep. So there are two main barriers we're going to have to deal with. The first being logging slash and debris. These are going to be treetops and limbs and sometimes entire unmerchantable trees that were left on the forest floor that couldn't be merchandised. And the other would be vegetation, because what we're doing when we're starting a plantation is we're basically setting back the ecological clock and making a very opportune growing site for early pioneering species. So to deal with these barriers, we have two primary types of site prep: mechanical and chemical site prep. Now, mechanical, as you might expect, involves going in there with a machine and somehow artificially scarifying the soil. Sometimes this is just done with a bulldozer, but more interestingly, I have seen it done with grapple skidders pulling entire ship anchor chains. In fact, here's a picture of that. So obviously this is a pretty, we'll say, aggressive process, and the goal of this is first to get rid of some of that logging slash and debris to actually expose the mineral soil, because you're going to want to plant the trees directly in the mineral soil to give the roots the best chance of thriving and thus decreasing the overall mortality of the planted seedlings. But the real downside here is there's really no specificity with what exactly you're prepping the site for with mechanical site prep. So you're creating a really great growing environment for virtually every herbaceous species and any other species of woody vegetation that's going to compete with your crop trees, your planted spruce trees. And this competition is really the largest issue with establishing a plantation, at least in the Northeast. It's huge. So I'm going to show you here a clip of a SilviCultural course that I filmed last summer. And in the stand, I believe this was only 1 year after planting. So just 1 year after planting, this stand was absolutely inundated with competing herbaceous and woody vegetation that, if left untreated, would just absolutely catapult the mortality rate to levels that we don't want to see. So the second option for site prep is chemical site prep. And as you can imagine, this is an application of herbicide prior to planting. But the advantage of chemical site prep is you can actually get a certain chemical formulation that can have soil activity, so it can continue to suppress some of this competing vegetation after the seedlings are planted. So it is really valuable for that. Also, since we're just dealing with 50 acres and this channel is aimed more towards small landowners, realistically, chemical site prep is going to be the most accessible. I mean, you can do some small scale mechanical site prep with a tractor or something, but it's pretty easy to do some form of chemical site prep with a backpack sprayer. So that's what I'm going to choose for this analysis. So we'll go in here and we'll do site prep. And this is going to vary the amount per acre, but we'll do 60. I think that's a pretty good estimate. And year, now for year, keep in mind, this isn't a calendar year. We're not talking about 2010, 2015. We're talking about 0 to the end of the rotation, so 0 to 50. So site prep, we're going to start that at year 0. So about a year after site prep, we can actually get to the planting. And this expense is going to involve both the labor of putting the trees in the ground and, of course, the cost of actually purchasing the seedlings or growing them, depending on what you're doing. So we're going to put in planting for expense number 2. And for an amount, I think 220 for both of those is probably a good estimate. And we're going to do that 1 year after site prep, so that would be year 1. And you can see that it's already starting to do some inflation adjustment based on the year. So the inflation adjustment just in 1 year is 224, whereas I put in 220. So that's how this calculator works. Great, so we planted the trees and now we can just sit back for 50 years and wait to reap the rewards, right? No, absolutely not. This is where the hard work really begins. So think back to that video that I posted with the vegetation coming in just 1 year after planting. This is going to be the story for the first 10 years of the plantation's life. So the next 2 expenses are going to be aimed at controlling that vegetation. So expense number 3, probably 1 or 2 years after planting, we can have another chemical release. This is another herbicide application. I'm going to put this in for $60 per acre. And we'll put this at year 2. I don't really think it matters year 2 or 3. It's going to be pretty negligible for the overall analysis. But I also do want to throw in real quick that in some parts of the country, like the Southeast, you might have a prescribed burning as an alternative to some of these treatments, particularly site prep. But we don't really do that in the Northeast too much, so I'm just going to ignore that option for now. So after 2 herbicide applications, we should be pretty good for a while, but eventually we're going to have to deal with the weakness of herbicide, and that is that the herbicide can only target species that are substantially different in function to the crop trees. Now, our crop trees, of course, are softwood, so we can get some hardwoods with the herbicide, but we're not going to get the softwood competition that's also going to grow in. So in the Northeast and in northern Maine in particular, we have balsam fir, which is better suited to these open environments than the spruces. So there's generally a lot of ingrowth of balsam fir, and they're going to compete pretty fiercely with the crop tree. So we have to remove those, but we can't use herbicide, so we have to go in and do a mechanical removal. We call this a plantation cleaning. We'll go in there with brush saws and we're going to manually clean out the stand. We're going to remove any maples, any balsam fir, any trees that are competing with the planted crop trees. And because this is all manual, it's a pretty expensive operation, so we're going to put down $200 per acre. And this will be done at year 10. But the good news is that gets us pretty well set up for the expenses, so now we can move on to the revenues, what we actually get as a return from the harvest from this stand. And for that, I'm going to defer back to this Norway spruce example. And we can see that the first removal was at age 24, which is going to be year 25 because we started at year 0 for site prep. So year 25, and we removed 9.5 cords per acre. And I did check in with a local group, and it seems to be the most current prices for spruce is about $60 per cord for the landowner. Now compare that to about $200 per cord I was getting logging my own land a couple years ago. Those are different situations. This is just what the landowner sees for selling the right to harvest the timber. That was what I got for logging my own land, and that was also when prices were higher. So $60 per cord. So 9.5 cords, $60 a cord, is $570 per acre. So we'll call this thinning, and 570 at year 25. And next up, just a few 9 years later, they had a second thinning in which they removed 20 cords per acre. So that gives us $1,200 per acre at year, what was it, 34? Yep, 34. Whoops, 34. All right, so next up in 2015, as I understand it, this is basically just an inventory statement. There was no thinning this year because they have 29.5 cords for total removed, and that adds up to these other two removals. It's a little bit confusing how they lay this out, but I'm pretty sure that's correct. All right, so they have 57 cords per acre standing at a growth of 1.9 cords per acre per year. So we're going to extrapolate that. This is 2015. We're going to extrapolate that to 2019 to get to the 50-year mark. And that will bring us to 64.6 cords per acre. And at 60, that's 3427. 3427. And we're going to call that a clear cut at year 50. All right, so if we scroll down here, we see a bunch of numbers. Now, what do they mean? So first off, our net present value is $22.91 per acre. So what is that telling us? That means, because it's a positive number, that means relative to the alternative use of capital, this represents a profitable endeavor. This is better than the alternative. And by the looks of it, just barely, because this is our internal rate of return estimation. So internal rate of return is basically the discount rate, the alternative use of capital, at which the investment represents a wash. The NPV equals 0. And it's an iterative analysis. So what this is doing is it's testing this analysis against different discount rates. And we can see the point at which the NPV crosses the 0 NPV line is right around 5. So our rate of return, our internal rate of return on this is basically 5%, and that's what I'm using as my discount rate. And you can see here some other numbers. One of my favorites to look at is the total nominal profit and loss. So this investment represents basically a total profit on a non-discounted basis of $300,000 almost. And of course, that's with prices rising with the pace of inflation. So that's kind of cool to look at, because I think it really reflects the power of timberland investments as an inflation hedge and how they can keep up with that over time. But then if we scroll down further, we can see these graphs that gives us a breakdown of the discounted revenues and expenses and how they fit into the overall net present value. So I think the most pertinent here is going to be the discounted expenses. So obviously, relative to most other forest investments, we had a lot of upfront expenses. But as we can see, they still were a minority of the overall discounted expenses. The biggest expense was still the purchase cost of the property, or rather the value locked in the property, because that was done at year 0, and that was $1,000. So more than property taxes or any of the individual investments into the plantation, the biggest thing hindering the rate of return of this plantation was just the value of the land itself, which is really interesting. Now, it is important to understand that we do actually recoup some of this cost on the revenues, because the way this analysis works, again, it's opportunity cost. So even if you aren't going to sell your land at the end of this rotation, just for simplicity's sakes, it assumes you're going to, and because you are presented with that decision. So it just assumes that you take back that money, but it is discounted heavily because it is 50 years into the future, and the inflation rate is only 2%, whereas the discount rate is 5%. So that means the net effect is a discount of 3% per year for 50 years. So we only get back a quarter, basically, of our money there. And based on the same principle, even though the money we actually got was only about a tenth of the final harvest, the first thinning actually represents about, what, a third? Yeah, a little less than a third of the value we got from the clear cut, because we were able to recoup that money a lot sooner. Now, there are some other considerations that you could potentially analyze here. Now, I think one thing that is interesting to look at is the value of the initial clear cut itself. So, and you can make an argument against what I'm saying. You can make the argument that this should be excluded. But if you are planting this in a stand, let's say it was a stand of diseased beech, or it was an otherwise very low value or unhealthy forest stand, and you're presented with two potential options. You could do, let's say, a selection cut to try to enhance the value of that as much as possible, or you could just clear cut it and start from scratch. Well, I think the value that you could get from clear cutting it relative to the alternative could fairly be counted in the revenue section of this analysis. So just for year 0, I'm going to put in, let's say the difference between doing a selection cut of a bad stand and a clear cut was a total of $200 per acre to the landowner. So, and that's not much, mind you, but it is at year 0. So again, that's not going to be discounted at all. First cut, I'll say. It's not going to be discounted at all, so it could go a long way in actually enhancing the return. Let's see how that works. And it looks like it gave us about 0.5% more per year and represents about 10% of our discounted revenues. Now, the other big thing to consider here is maybe it's not wise to cut at year 50. Maybe it would make sense to wait 10 more years when it's growing so well. Maybe it would make more sense to cut it 5 years earlier. And of course, this is going to be affected by the discount rate, because the higher the discount rate is, the more it's moved out, then the more time it will be exposed to that high discount rate. So it's going to eat away at more of that value. And of course, cutting it 5 years earlier would have the opposite effect. And here's where it gets tricky and where ultimately these analyses come down to some personal judgment. So earlier I chose a 5% discount rate and a 2% rate of inflation. So that means that our net discount rate is essentially 3%. And usually what I would argue for is a 1% net discount rate, so one above the rate of inflation. And the reason why is because trees really are one of the most risk-free forms of investment. I know there is risk, I'm not saying there isn't, but compared to other assets, they really are unique. And so it really is hard to compare this investment against another investment that's going to have similar risks. And of course, plantations, they do require some upfront capital. However, all that risk is front loaded. After the first 10 years, the risk of mass mortality is pretty low. You can still have fires, you can still have insect outbreaks, but I mean, when you first put those trees in the ground, there's a lot of things that can go wrong, and it's pretty common. But for example, in northern Maine, I have not, I'm not saying it's never happened. And we have a lot of plantations up here. I've never heard a story of a plantation over 10 years being absolutely obliterated. Norway spruce even. Actually, it's funny. Famously, this stand of Norway spruce, this was hit very hard by white pine weevil, at least that's what I've been told, and it just kind of grew out of that attack. It was able to withstand it, and now it's this beautiful stand today. So after year 10, a lot of those risks really tend to diminish pretty drastically. And so if we're looking at this analysis and we're trying to maintain that 5% discount rate at age 45, does that really make sense? If we're looking at the difference between age 45 and 50, is there something else that can represent the same risk that we can put that money in versus this 45-year-old plantation? I'd probably argue no, and that's just kind of one of the nuances you have to deal with. Now, obviously, you would have the prerogative to cut this whenever you want and put it in whatever investment you want, but it's just, you just have to be careful of what you're actually measuring, what you're actually comparing. If you want to make the decision to cut this plantation and then put that money into Dogecoin, that's on you, but it's not a sound economic analysis if you put 20% as the discount rate, expecting to make that from Dogecoin. And on that note, and this is a common error a lot of people make in the industry, we can't use this to maximize internal rate of return. We can't just look at this number right here and try to get this curve to intersect as far along the graph as possible to try to get an 8% IRR. Because if that would involve cutting the stand, let's say 10 years earlier, well, what are you going to do with that money at that point? Because there's 10 years where that money has to be put somewhere to get that alternative rate of return. Otherwise, you're actually losing money. And this is where timberland can be a little tricky, because it's not like a bank. If you put money into a compounding bank account, that's basically infinite. Your money will just keep compounding forever, but you have to put the money back into the forest. Once the tree itself is the compounding effect, and once you sever that stem, it's no longer growing. You have to put that money somewhere. And if the money's just sitting there idle, or especially if it gets lost in a risky investment during that 10 years where it could have been growing but you decided to cut it early, what's it doing? You have to account for that. So it really is about comparing this to an alternative investment. And to do that, you have to actually be comparing it to something real and comparing it to something fair. All right, so finally, the big question, is 5% a big number? Is it a great return? And that's entirely dependent on your perspective. But I do think something that's good to point out here is that I mentioned previously that this is the best case scenario for the actual per acre production of wood. Does this 5% represent the best case scenario for the per acre production of value? And the answer is absolutely not, because the big problem with plantations is that we have all these expenses upfront working against us. The vast majority of silvicultural treatments do not have this, or if they do, it's a fraction of what they are for a plantation. So if we're doing a selection cut, there's basically no expenses involved in doing a selection system. It's all just periodic revenues, and the only thing that factors into it are your property taxes and the actual opportunity cost of having the capital in the land itself. Also, you can do a lot on a selection cut in the meantime. If you are in an area where there's hunting leases, obviously a selection cut is going to be a lot more valuable for a hunting lease than a plantation. If you're doing some firewood sales, that represents a yearly revenue, which can have a really profound impact on your net present value and internal rate of return, because it's happening every year and can pretty much negate or completely overcome the property taxes. And we'll talk about that more later. But does this plantation represent an excellent opportunity relative to the forest that was standing there before? And oftentimes, yes. Now, if you have a very poor quality forest, if you have poor health, disease, something like that, invasives, this can be a great way to turn an unproductive and unprofitable forest into a great opportunity. And really, to me, that's what plantations are about. Sometimes plantations can be controversial, I understand that, but it's just a tool in the tool belt, and sometimes they can be a very powerful tool, but they're definitely not the end-all be-all. So anyway, I wanted to kind of show you guys more of this financial analysis tool on SilviCultural, and I thought kind of discussing plantations and the economics behind plantations would be a great way to do that. So if you want to get this, this is available to premium SilviCultural members. And of course, SilviCultural, the community, is now free, so please go on there and join. A lot of you already have. And thank you so much to those who have joined so far, but there's a lot more of you that need to join. So if you're interested in joining, go on there and get your free account, come in and say hi. And if you want to play around with this tool, then you're going to have to get premium. All right, that's all for now, guys. See you later.